You're about to hear 4 stock pitches that these students have been working on through the course of a semester. I think we've got 3 technology and maybe 1 healthcare. So a good mix. A lot of hard work went into these. This is the culmination of, again, an entire semester's worth of modeling and late nights and consultations with a lot of people around the club. So please give them your full attention. I think that this is for leadership one of our proudest moments where we're getting to kind of watch our talent on stage. It's a really special night. So thank you for participating. We're glad you're here. Without further ado, please welcome Veronica and her JAs. We'll be hearing first from Jazz Pharmaceuticals. Thank you.
Good evening, guys. Today we will be pitching Jazz Pharmaceuticals. My name is Veronica. I'm a sophomore double majoring in neuroscience and economics, and I'm the senior analyst.
I'm Pedro. I'm a freshman studying economics and computer science.
I'm Darius. I'm a freshman studying economics and mathematics.
I'm Koto. I'm a freshman studying biomedical engineering.
I'm Ryan, and I'm studying business with a concentration in law.
Today we're initiating a buy on Jazz Pharmaceuticals with a target price of $150, suggesting 37% upside. Jazz Pharmaceutical is a global biopharma company who produces neuroscientific drugs as well as robust yet undervalued oncological drugs. The street is concerned about the generics erosion of Xyrem, which is their leading product. However, this is an overstatement because of Xyrem's payers lock-in as well as clinical security.
Jazz operates in the rare disease market, which has been growing at a CAGR of 9.3%. They focus on therapies for conditions with high unmet medical need and no standard of care. As a result, the demand for these drugs is highly inelastic, which grants companies with strong pricing power. The threat of new entrants and substitutes is also low, given how specific these diseases and treatments are. This also limits buyer power, since there really aren't that many suppliers in the industry. So it's safe to say that once a company has established itself in the industry, the force is large to support growth.
Jazz operates on 2 main segments. One is neuroscience, and the other one is growing oncological drugs, as you can see on this graph. Their drugs are supporting diseases that are niche yet often life-threatening, and that is why they have been benefiting from FDA's accelerated approvals. Another differentiator of this business would be the presence of Jazz Care, which provides patients with personalized support as well as financial aid for some cases.
Jazz has successfully leveraged orphan drug exclusivity, or ODE, across its core oncology and neuroscience portfolios. ODE is granted to treatments treating rare diseases affecting under 200,000 people in the United States, offering 7 years of market exclusivity, as well as key benefits like waived FDA fees, as well as tax credits. Several of Jazz's therapies have either been licensed or acquired, and many of which are the best and only therapies in their categories.
For over 15 years, Jazz has led the transformation of oxybate therapy, with a lead market product, Xyrem, a sodium-based therapy for the treatment of narcolepsy. Although the patent on Xyrem expired in 2023, this isn't the end of the oxybate franchise. We now have a new, better version of Xyrem called Xylove, which has shown tremendous market adoption. This drug is positioned to reach new patient populations that were previously excluded from treatment due to high sodium concerns. Additionally, they were able to tap into an entirely new market of idiopathic hypersomnia patients, a disease with lots of unmet need and no other treatment options available. Essentially, an opportunity for them to expand their total addressable market without the need for building new channels. The oxybate franchise doesn't follow your typical patent cliff narrative, and this is because Jazz has strategically locked in payer preference and blocked generic access, but not through pricing games, but rather tactical contracting. Through its contracts with 3 of the country's main pharmacy benefit managers, Xylove has become the go-to option for patients previously on Xyrem. This means that Xylove has taken over 90% of patients who were previously on the old drug, blocking generics from getting that first-line access. The bottom line is that payers prefer to cover Xylove, and that means margin stability, volume protection, as well as long-term visibility into cash flows way into the future, even in the post-patent world. The REMS model limits the distribution of oxybates to one centralized pharmacy, making the switch to generics a lot more difficult. It's a strategic move. It's a logistical wall. What that means is that a patient can't just go to Walgreens or CVS and pick up a generic. What they have to do is they have to get a new prescription through a REMS certified prescriber and have to undergo a whole new re-enrollment process, which involves a lot of onboarding, like blood work and extra documentation. Through this centralized control, Jazz is able to limit formulary override, as well as substitution. They're able to protect their gross to net margins without competing on a price list, and they have full visibility into adherence and side effects, as well as retention, which is data that most pharma companies could only dream of. The FDA deems this new drug, Xylove, to be clinically superior to Xyrem and its generics. Why? The sodium content. Take a look at this graph here. It shows the difference in sodium content between high sodium oxybates, like Xyrem and its generics, and this new drug, Xylove. There's a striking difference of 1,500 milligrams a day. To put that into perspective for you all, that is roughly the sodium content of 4 large McDonald's fries. Taking the old version of the drug, or its generics, puts you close to or above those recommended thresholds before even considering dietary sodium intake, making this new drug, Xylove, the safer option. Combination trials, like the ones that Jazz is pursuing, are a very capital-efficient way to bring drugs to market faster and at a lower cost. When you're adding onto an existing backbone, like chemotherapy, radiotherapy, a lot of regulators are a little more comfortable using something called surrogate endpoints. So looking at metrics like progression-free survival or overall survival rate, as opposed to waiting for long-term survival data to come out, which could take years and years to collect. There's really no need for Jazz to run massive global trials. When you're adding to a known standard of care, it's easier to show benefit in smaller groups of patients. And if the FDA deems the combination therapy to have superior therapeutic value, then they will further expedite its approval process. Let's take a minute to talk about zanidatamab. This is a key asset in the oncology pipeline for Jazz, and it is very important both commercially and scientifically. Zanidatamab has a differentiated mechanism of action, which makes it uniquely effective across lots of different tumor types. Just in November, zanidatamab was approved for its first indication in biliary tract cancer under the name Ziihera, and it's already shown to have a best-in-class profile and is the only drug on the market. This approval really gives Jazz a commercial foothold, but the true exciting thing lies in this upside that comes from the pipeline, from all of these trials being done on larger tumor types.
Zanidatamab, currently marketed as Ziihera, is a HER2-targeted therapy developed by Jazz with over $2 billion in peak revenue potential. This medicine is for aggressive and metastatic cancers driven by an overexpression of the HER2 protein and is often fatal without timely intervention. It's already approved in the biliary tract cancer. In the gastro pipeline, it's set to overtake Herceptin, the current market leader. But the biggest opportunity of all lies in breast cancer, where zanidatamab is set to become a first-line treatment, possibly replacing the need for traditional chemotherapy as a whole.
And as another step to grow their oncology portfolio, Jazz has just acquired Chimerix and their lead asset, which is a drug that treats a rare and aggressive brain tumor in children, currently under FDA priority review. With patent protection through 2037, this drug may even expand its use to other applications. So overall, this really is a compelling near-term revenue catalyst for Jazz.
So Jazz is not debt-free by any means, but the way that they manage their debt is what sets them apart. They've been able to improve their leverage from around 9x to around 2.3x since acquiring GW. And this deleveraging was done entirely using operating and free cash flow, not through the sale of assets or dilution. This deleveraging wasn't just for optics. This deleveraging is made possible through the robust cash flows. It's these robust cash flows that allow this deleveraging to be strategic and sustainable in the long term. Jazz trades at a shocking 4.7 price to free cash flow. That's a multiple that you'd expect from a no-growth industrial company, not a profitable biotech with 33% EBITDA margins. Their free cash flow yield of almost 17% reflects a rare combination of scale, discipline, and flexibility. At this level, they can reinvest, they can delever, and they can return cash to shareholders more aggressively. Just take a look at their 2024 stats. $1.4 billion in cash from operations, $3 billion in liquidity, and $885 million undrawn. This cash flow is real, recurring, and undervalued by the market.
The main risk with Jazz Pharmaceuticals is the REMS model, distributing Xywap and Xyrem from one central pharmacy. Although this model has worked well for over 20 years, it does create a concentration risk. Jazz also has two smaller secondary concerns, which are consistent through the biotech industry as a whole. The first being that drugs in the pipeline are not guaranteed to get approved. And the second being, when these drugs are approved, it's no guarantee they'll reach the market share that we originally projected.
So here's what you need to believe. For one, the market is overstating the Xyrem patent cliff. It is not like this in reality, and this is because there's this complete ignorance from the market side on Xywap's lock-in with payers and its clinical superiority as a whole, and that transition of the patients that are being lost from Xyrem onto Xywap. Next, the market is also overlooking Jazz's high-margin oncology portfolio, which is enabled by those fast-track, lower-cost approvals, as well as approvals across multiple different indications. And lastly, financial resistance. Look at how they manage their balance sheet. They manage their balance sheet, they de-lever without sacrificing growth. These robust cash flows put them in a very favorable position relative to their competitors. Thank you.
Why is their ROIC so low but the margin so high?
Yeah, their ROIC has been, their ROIC has been declining a little bit, and this is because they hit a couple of, walls, especially with the Xyrem patent wall. I think that was a really, really big concern for investors, that a lot of kind of revenue erosion would happen there, but honestly, a lot less revenue erosion is happening than was expected. I think kind of moving forward, the ROIC is going to grow. If you take a look at our projections into the future, and this is mainly coming from that upside of the oncology pipeline that is able to kind of overshadow what's happening with that neuro franchise. Although I do have to say that the sleep franchise, even though that revenue is eroding, it's not eroding at the speed that the market thinks.
Has this company done acquisitions in the past?
Yes, they've actually done quite a few acquisitions. Oh, sorry.
Can you just show me the balance sheet?
Yeah.
If not, it's not.
We had a nice linked appendix for the weekend.
All right, so it's the intangible, it's basically acquired R&D, which is why.
Yeah.
it's
So a lot of
low.
it.
Yep.
Yeah, a lot of it is either in-process acquired R&D, or it is already a ready product. If we take a look at some of their acquisitions here. These are some of their past acquisitions since around 2019. As you can see, they really kind of target companies that have late-stage assets with a lot of intellectual property kind of protection there. These are both kind of across central nervous system diseases as well as oncology, and they're quite significant and have been proven to be very successful and successfully integrated. For example, the GW acquisition, that was a very immense acquisition of $7 billion. but they've been able to successfully re-lever after that. The GW acquisition really brought in a key asset for them, Epidiolex, which is a cannabis-derived drug, and it's the only FDA-approved cannabis-derived drug. And it's proved to be very kind of clinically meaningful and the drug of choice for a lot of patients, and is now being tested across other indications too. I think other things are, for example, Zepzelca. Zepzelca is a drug for small lung cancer, and that was actually licensed from PharmaMar, and they pay royalties to PharmaMar regularly. So yeah, it's kind of a mix of acquiring ready assets or kind of whole companies and integrating that, but I have to say that they've been very successful at integrating.
Thank you.
Can you go back to your balance sheet, please?
Yeah.
Perfect. Why are you impairing or amortizing your intangibles? You think they go up for a pharma company?
Yeah, I mean, a lot of them go down, right? And this is because of kind of losing patent protection and losing different kinds of exclusivity. So yes, amortization does go down, but because they are acquiring so many things, they're able to kind of offset some of those losses. So yeah, I did assume that amortization kind of stays flat.
I was wondering if you could walk us through why you think the street is a little more bearish on oncology.
Yeah. So I think the oncology sector has always been overlooked. I think kind of historically, Jazz has always operated as a neuroscience company, specifically with a sleep franchise. And I think that what a lot of people are struggling with is the idea of whether Jazz will actually be able to execute on that pipeline, given that they are so new in this space. And quite honestly, I think so. I think the market is kind of in a place where they feel that Jazz is new to the space and there's so much potential, but there's not a lot of expertise there. But I would disagree. For one, I would say that their commercial infrastructure is built exactly the way it's supposed to for the approval of rare disease drugs. And I think a lot of people think that there's a huge kind of difference in approving an oncology drug versus a neurology drug, but I would disagree. I think it's more so the fact that we are focusing on rare diseases. That's for one. Two, I think they've done a really great job at kind of integrating their acquisitions. And I think that there's a potential near-term upside that's coming with the recent acquisition of Chimerix and their lead asset that kind of hasn't been baked into street consensus yet. And I do think that kind of that will follow the typical pattern of how they usually, kind of take in these new assets and build on them. And then lastly, I would say these kind of combination therapies, right? They acquire a drug, something like zanidatamab, and they test this drug across numerous different indications. They test it as a first-line treatment, a second-line treatment. They test it together with chemotherapy, with radiotherapy. You have one asset that becomes an entire pipeline. I think what other pharma companies in this space are doing, especially the small to mid-cap biotechs, is really focusing on, building a paradigm-shifting drug that's kind of a standalone, right? Like, let's find a cure for cancer, let's find a cure for Alzheimer's. I think that this is really unique on their side, and they have really shown to be very successful at leveraging that.
I'm just trying to size up the TAM for something like a narcolepsy drug. Do you know if Medicare and Medicaid consider those to be elective and therefore would not be covered, or if that would be under their...
Yeah, so a lot of those are considered non-elective treatments. Something like narcolepsy depends on kind of the extent of the symptoms, right? But a lot of the rare diseases that they are focusing on are considered to be kind of mandatory treatments. I think if you listen also to management and look specifically at some of their conditions, for example, the drug that they're acquiring for Chimerix right now, the lead asset that they're acquiring with this new acquisition is a drug that treats brain tumors in kids that have a 1-month prognosis. So if they don't get this drug, there's no other option. So yes, they've had kind of favorable coverage in the past. Over 90% of the patients are covered by either governmental insurers or kind of private insurance companies, and they have very favorable relationships with pharmacy benefit managers as well, especially through their REMS model. So yes, that's definitely helped them in the past.
All right, well, thank you so much, guys.
can turn it off. So I think it went. Oh, speaker.
All right, next up we've got Dropbox. Laurent, come on up.
Hi everybody, thanks for taking time out of your Monday night to come watch me talk for 10 minutes. My name is Laurent and I'll be pitching Dropbox today. So, what is Dropbox? It is a cloud-based content collaboration and productivity platform that operates in over 180 countries, and it's expanding into not just storage, but workflow automation and productivity through upselling add-on products like signing, Dash, and artificial intelligence that's going to increase its user retention. I am issuing a buy rating on Dropbox with a price target of $35 with 24% upside. I'm doing this because the market is pricing in the fact that there's rising customer acquisition costs, and Dropbox is just a file storage SaaS model that's reaching maturity and is about to go out of style. However, I think that the market is underestimating the strong retention rates of Dropbox and its possibility to expand into more average revenue per user growth and expand to more productivity platform that will expand its life cycle. My key investment thesis is Dropbox's high retention rates and low churn, combined with their domination of small to medium-sized businesses, creates stable recurring revenue and pricing power, and the market is underappreciating the potential to monetize their existing user base and significantly expand their revenue, which will lead to significant upside. So, beginning, Dropbox operates in the file, sync, and share market, which is basically software that allows users to store, sync, share, and collaborate on files across devices and teams. This industry is experiencing rapid growth fueled by the growth of remote work after COVID and SaaS expansion in general. Dropbox is currently the second largest player in this industry. However, it's not bundled with any other type of software. While Google and Microsoft have multiple different types of software bundling with their own types of artificial intelligences, Dropbox doesn't have any of that, so it remains the leading independent platform in this market. And the market is still highly fragmented with 15.9% in the rest of the market, which means that Dropbox has an open lane to dominate. One key characteristic that I want to point out is these types of software as a service companies have very high switching costs. As data heavily builds up, meaning that the complexity and time commitment of migrating this amount of data to other platforms is extremely difficult. Real-time sharing, commenting, and version control is going to embed these types of platforms into daily workflows, which will make each of these switching away way harder. One more thing I want to point out is that as artificial intelligence enhances the amount of content and the quality of that content for data storage, the stickiness and the industry churn is going to decrease even more. So, Dropbox operates on a freemium funnel model, which basically means that they have 700 million registered users, and the way that they create revenue out of that is that they're upselling their plans for more paid business plans such as Business, Sign, and Dash. This is acquiring millions of users organically through word of mouth and referral programs, and they're focusing on shifting these free users, which they have already gained, to paid tiers by enhancing the paid tier and reducing the quality of their free tier, which is gradually going to increase revenue over time. They have steadily a 3% conversion rate with a multi-layer path to monetization, starting with storage and expanding to tools like I've listed here. Their long-term customer acquisition is already complete. They have minimized the need for any type of new sales and marketing expenses. Now they're just focusing on upping that conversion rate. One more thing that I want to point out is the fact that 80% of their client revenue comes from small to medium-sized businesses, which we'll talk about later. So, as I just mentioned, my first thesis point is the fact that their user stickiness is beyond anything any other competitors in the market. Dropbox's key advantage is the high consumer retention that it enjoys, and most SaaS companies are highly dependent on daily engagement, while Dropbox benefits from this high retention driven by these high switching costs that I just mentioned earlier. This also leads to significant pricing power. In 2022, Dropbox raised prices on its legacy partners by over 20%, and their churn rate barely moved at all, showing how they can expand RPU without needing to fear about losing customers due to these raising prices. This is called something called the digital landfill effect. How many of you have had a file that you're storing in your Google Drive or your Microsoft and you deleted it? Most likely never, because you're afraid that you might need that file one day, right? So users are barely deleting files because they're afraid of losing valuable data. And this is creating extremely stable recurring revenue for Dropbox, and there's way less expenses needed to maintain their consumer base. As you can see, Dropbox enjoys the third lowest industry churn rate among their competitors, and the churn rate is going to incrementally decrease over the 5-year projected period. So my second thesis point is that Dropbox specifically caters to small and medium-sized businesses. They deliberately position themselves as this platform because their ecosystem neutrality and their fast deployment make it a very simple platform to get started on immediately. This is what SMBs need because they're not fighting for large enterprise IT contracts. They need simplicity because they operate on a small business model. So while competitors are focusing on these large enterprise contracts, such as Google and Microsoft, Dropbox doesn't need to play in that field. They're capitalizing on a fragmented and underserved client base. This is creating significant upselling opportunities for small and medium-sized businesses, which is creating significant potential to expand RPU and customer lifetime value. As you can see from its competitors, they're focusing 80% on SMBs and 20% on enterprises, while these other companies are focusing majority on these big companies. And if you look at this graph over here, the blue dotted line is the average S&M as a percent of revenue that these companies are spending to maintain their consumer base. But Dropbox, because they're focusing more on SMBs, are incrementally decreasing that revenue, which is going to lead to compounding margin advantage. They're designed for instant activation, and they're the ideal SaaS model for SMBs because they prioritize easy usage, unlike enterprise platforms. And since they renew indefinitely once embedded, as most SMBs do, it's going to drive stable and predictable revenue with low reinvestment needs. So I've established that these consumers are very sticky, high retention, they're not going to leave, and I've established that it's the perfect type of consumer to be upsold. But I can hear you thinking, Laurent, you have established this very sticky consumer base, but you gave us nothing that says Dropbox is actually going to capitalize on this. Your pitch sucks, get out. So, this.
Why is it easier to search the entire internet than your own stuff? Meet Dash, the universal search tool by Dropbox. With every app, every tab, and everything on your to-do list competing for your attention all at once, Dash finds what you're looking for fast, no matter where it is, what it is, or how long it's been since you've last seen it. Even the link you sent weeks ago during a mid-project breakthrough, the one that could change everything. Now that you've found it, we started with storing files. Now you can search and stay organized across all your apps, all your tabs, all in one place, so you can get it all done and get on with your day.
So, Dropbox Dash for Business is an AI-powered productivity artificial intelligence focusing on search, workflow automation, and knowledge retrieval. One very important thing about it is that it uses third-party artificial intelligence like OpenAI, which is what ChatGPT uses, and Anthropic. This is avoiding the heavy capital expenditures that are usually tied with building and maintaining these AI models. This is a natural, very low-cost upsell that doesn't need to incur more S&M, and it can scale to millions of users without increasing any more expenses. Even a 10% adoption of Dash among its paying user base can result in over $100 million in annual recurring revenue. Also, they have over 1 trillion pieces of user-generated data, as you can see by its total content storage over the past 5 years, that they can use to train Dash and on user availability and behavior. And this creates a unique competitive advantage that gives Dash a stronger value proposition. Now, you might have noticed in the video that Dash was able to pull from a Google document and Google Drive, but it's a different software. This is because Dash is one of the only AI-powered search tools that is ecosystem agnostic, which means it can access all these different types of platforms simultaneously. This is an indispensable tool for small to medium-sized businesses and freelancers that are trying to manage multiple things at once. And it gives Dropbox great value proposition, great competitive advantage, and a strong runway to dominate. So, return on invested capital. Since Dropbox uses these third-party models and decreases their capital expenditures, Dropbox can focus more research and development expenses and software development capital expenditures and move them elsewhere. They can efficiently scale and monetize Dash without compressing their free cash flows. As you can see, there's going to be an initial gross margin compression over in 2025 because I'm predicting that with the rollout of Dash and with the inevitable types of bugs and service and maintenance costs that they'll need to have, gross margin is going to decrease. But since incremental S&M is incrementally decreasing over the projection period, we're going to see increasing returns over time, and ROIC is going to spike up to the 50s. And invested capital is also going to be incrementally decreased as Dropbox moves towards more capital-light expansion, as you can see with the third-party AI models. On ROIC, as you can see on this side, Dropbox IPO'd in 2018. The market viewed it as a very growth stage SaaS model, but as it moves towards maturity, the market is believing that Dropbox is now outdated, it's more mature in its SaaS, and it's starting to move more with ROIC. So I'm predicting that as ROIC moves with EV over EBITDA, the market is going to start trading as such. ROIC expansion is also indicating efficient capital deployment, especially when paired with these strong margins and this capital-light expansion. And the multiple is pricing in only the slowing, stagnating paid user growth, and it's not considering the superior margins and the monetization opportunities for its RP. So, big question, how is my view differentiated from the view of the market? I believe that the market is pricing in the rising customer acquisition costs and the slowing paying user growth, thinking that Dropbox is a storage company that's going out of date. However, I believe that since RPU has the potential to grow significantly with Dash's rollout, as Dash shifts from a pure storage platform to a broader productivity platform, RPU expansion is going to offset this slowing user growth and result in stable revenue at around 3% growth. Dropbox's add-ons are also going to embed way deeper into workflows. Since AI is increasing the quantity and quality of data being stored, the digital landfill that I mentioned earlier is going to turn into a digital canyon, as way more data is going to need to be stored and churn rates are going to need to decrease significantly. As you can see from here, I'm actually a little bit more bearish when it comes to what I'm projecting paying users to be, but when it comes to my RPU projections, it's way higher than the street and it's going to offset that revenue. So, here's my revenue build. My key factors are the fact, what I mentioned before, that paying user growth is going to stagnate, but RPU is going to drive expansion. Upsold users are expected to adopt win more add-on products such as Dash, Sign, things like that, with around 3% conversion. And projected total RPU is going to be this upselling revenue plus the base average revenue per user. Some key assumptions that I want to touch on is, for my base case, I'm predicting around 7% paying users are going to buy Dash. Bull case is going to be around 11%, and bear case is going to be around 3%, which is consistent with the past 5 years. I'm assuming Dash should be $24.99 based on announced price points and previous add-on pricing, and I'm not really assuming that the top-line registered users are going to grow in any other capacity. Also, one more big thing, churn is going to decrease from 11 to 9% incrementally as the amount of data increases and switching costs rise even more. So, my risk slide, I think that two of the biggest risks are going to be what I touched on before, being upselling and conversion. These low conversion rates are going to lead to higher tier products like Dash. The low conversion rates of higher tier products such as Dash is going to significantly starve RPU if it's not high enough. So I believe that if the upsell rate is below 3%, I would need to rethink my investment thesis. A smaller one is the monetization risk, being that the amount of R&D that Dropbox is putting towards Dash, it might not come to anything and lead to margin compression. And finally, churn risk, I believe that if more users start to leave because of price sensitivity due to economic contractions or recession, I believe that if churn is above 14%, I would also need to rethink my investment thesis. So those are just some things to watch out for. Finally, industry-leading retention rates and low churn are going to drive very stable recurring revenue and sticky consumer base. And this user-friendly SaaS model is going to position Dropbox to dominate this very fragmented small to medium-sized business market. They're going to leverage ecosystem-agnostic platforms and create large competitive advantage and value proposition. And finally, in my view versus the street's view, I believe that the market is pricing in these high acquisition costs and they're stagnating paying users, but they're undervaluing the ability to monetize a very stable consumer base. Thank you.
Two questions for you, actually. So those customers that are being upsold, do you have any breakdown between whether they are mostly enterprise users versus just normal business users?
Yeah, I believe that enterprise users are not really going to be the ones that upsold, because when you're selling to an enterprise, those prices are usually being customized. They're not going to be changed over time because they're like originally negotiated from Dropbox to the enterprise itself. So they can't really upsell in that regard. I think that SMBs that are paying on like a fixed price point, those are going to be the ones that can incrementally use up all their storage and have the opportunity to be upsold more. So I think it's going to be mostly SMBs that are going to be upselling to Dash.
Okay, and then my second one was, could you just, I guess, just give us some color on what the street's saying about Dash? Because I mean, there must be some delta in your views, just because you're conceding that, you know, user growth is probably going to stagnate, yes, but ARPU should be driven, and most of that, it sounds like, is going to be Dash. So what's the street saying about that?
So Dash is actually not released yet. It's in very, very low beta, and I think the street, because the market is now like uncertainty and AI is the big thing that everyone's talking about. And although AI is very speculative in sense, people are also very nervous about it. I think that most people, since it's also not out yet, are not realizing how much of a significant pricing point this is going to be for Dash. So they're assuming that our view projections are going to follow the same trend that paying users are going to follow in terms of the stagnation, and that's why the pricing is so low.
You didn't really talk about the risk of actually deploying Dash. I mean, we've seen issues with Apple Intelligence and other pretty large companies having troubles deploying successful artificial intelligence. So could you just talk about that a little bit?
Yeah, so I actually touched on that when I talked about the fact that the gross margin will compress. I think it's going from around 81% to 77%. This is how I'm taking that into account. I think that's actually I think it's like a more conservative estimate because I'm taking into account the fact that there's going to be inevitable bugs, there's going to be inevitable problems with rolling out this artificial intelligence. So I think that being the fact that it's compressing a little bit, I'm taking that risk into account when I'm trying to project how Dash is going to impact revenue overall.
Sorry, I'm good.
How confident are you that churn is going to stay where it is? Are they taking price on the paying users that aren't getting upsold to Dash, or are they, and how have those users responded to sort of price increases?
Yeah, so like I touched on before, in 2022 they increased prices by 20%, churn barely moved. I think that Dropbox in general, since they are starting to experience paying user stagnation, they're not going to take the risk and take price on anything as they're rolling out Dash. And I believe that I have base RPU that's not included with Dash increasing by a conservative like 1 to 2%. I think that once they get more steady with how Dash is performing on their user base, yes, they might take price, but that's going to be a significantly long time down the road before they can like successfully implement Dash into their systems. I think only then they would have the confidence to actually implement that type of price increase. Chris?
I know you said Dash hasn't been released yet. Has management talked about the ability of Dash to maybe even convert free users, so not even paying users currently? And if so, how do you maybe factor that into your model?
Yeah, so when I talked about converting registered users to paid, I kind of kept the same trend of converting around 3%. I don't think I took into account the fact that free users could completely convert to paying because since Dash is very speculative and it's only priced as an add-on with a paid plan, I think that's too much of a price jump to take when you're considering the fact that Dash is already very speculative and it's already going to be very new. So I didn't want to take that big leap and assume that this would cause that much of a spike in revenue because I wanted to take into account the fact that Dash is already very new and there could be some risk in terms of that. So I wanted to be conservative in my estimate. Any other questions?
Thank you.
All right, thanks, Marvin.
Alright, next up we'll have William Sohn pitching Atleos.
Sorry. Hello everyone, my name is William Sohn, and today I'll be pitching to you Atleos. So NCR Atleos is a self-service banking solutions provider for both financial institutions and retailers alike. They're a recent spin-off of NCR Corporations, and with their new strategy of ATM as a service, they're looking to increase their annual recurring revenue mix, as well as expand their EBITDA margin and increase their free cash flow rate. The market is currently has a low multiple on this company because of its short track record, as well as its high net leverage comparable to its other companies, but this should come down in the recent coming years. I'm sitting at buy $55 with a 106% upside. So just to talk about the ATM industry as a whole, this is around a $25 billion business with a 3.6% CAGR, and it's mainly dominated by 3 players, those being NCR Atleos, Diebold Nixendorf, and Hyosung. So in this industry, there's not really the risk of new competitors, and really to be competitive, you need to have the highest technology ATMs, as well as being able to differentiate yourself. Out of the 1.89 million ATM units that exist in the space, around 680,000 of them are controlled, maintenance or owned by Atleos. So in order for them to be successful, they need to continue to be able to differentiate themselves, as well as having the most advanced ATM technologies. So going on to Atleos itself, their revenue is mainly divided into 2 big sections. The first being self-service banking. So this is going to be the 3 different sections, which is the maintenance of ATMs, the managing of ATMs, and the full outsourcing of ATMs, which they call ATM as a service. We'll go more into about this later. There are other sections going to be their network. So all your retail stores such as CVS, Walgreens, Costco, the ATMs there access a network called Allpoint, which is owned by NCR Atleos. And so this is also another way that NCR Atleos is able to generate most of its revenue. And they do have a TNT sector, but management is not particularly concerned with this. It's less than 5% of the revenue, and it's expected to see a flatline growth for this, or no growth, I'm sorry, flatline over the years. I also do want to point out that their annually recurring revenue mix is around 73%, which expanded around 200 basis points in 2024. So going back to their ATM as a service offering, they're wanting to increase the amount of units on the ATM as a service in a couple ways. The first way they're going to do this is they're going to uptake clients through this continuum that they have through the hardware recycle. So currently in 2025, 26, 27, we should see a new recycling of hardware for all of their clients. And so what they're going to do is they're going to approach their customers and say, hey, look, we do pure maintenance on your ATM. Why don't we do some software or some security for your business? And that will move that unit into the managed unit section. For the units in the managed unit section, they'll go up to them and say, hey, why don't we do everything for you? And you can outsource this entirely for a flat fee, and that will move them to the ATM as a unit section. So with this hardware recycle, they're looking to re-sign these contracts into bringing their clients up this continuum. For the network growth itself, there is a recent decline of the amount of units on the network, but that is just because Walgreens and stores like this have been closing their low traffic stores. So while this initially looks bad for NCR Atleos, the units that got taken off were low revenue in the first place, and they're going to offset this by growing their markets into Brazil and Argentina, where they're looking to establish a network there, potentially Italy as well. And recently they did sign a deal with FCTI, which is a partnership with 7-Eleven to add 4,000 units to their base, which would bring their numbers back up to what it was in 2024. So the way I tried to build my revenue was based off of historic at-mass attribution, as well as the future breaking into markets. So in 2024, management had said that they broke into around 11 markets, which was around 12,000 at-mass units. So in the future, they projected they're going to look into 36 new markets using the same ratio. This is about 45,000 units. I also do want to point out that most of the projections for other analyst coverages in the street, they have a 2026 EV over EBITDA multiple, which is, they're also projecting the same revenue growth, the same EBITDA margins, the same free cash flow growth, but the only difference is that their net leverage, or the net debt is different. So moving on to the expanding of fundamentals with the adoption of at-mass, we should see a large growth into their EBITDA margin. So historically, over the last year, their EBITDA margin expanded over 600 points. Their adjusted EBITDA expanded at 440 basis points. In the future, we should see a growth of around 7 to 10%. So this is going to continue to expand in the future with a further acquisition of at-mass for their clients. And additionally, at-mass was originally thought to be a capital-intensive business because with these new clients and their hardware agreements, it was originally thought we're going to need to buy new hardware. However, they found that only around 20 to 30% of these deals actually needed new hardware. And additionally, what at-mass is trying to do, what Atleos is trying to do is they're trying to outsource and have a third party finance the hardware for this institution, lowering the capital intensity. So we should see a growth in the invested capital into the future. So moving on to the actual multiple itself, they're currently trading at a 5.3x EV over EBITDA. There's two main reasons for why it's so low compared to its other investors, considering its position in the market. That's because of its net leverage and its short track record. They recently came from a spinoff of NCR Corporations, so they've only been out for one full fiscal year, and Q1 of 25 will represent the sixth quarter that they've been out as an independent company. So as Atleos continues to grow, continues to show their growth in their fundamentals, their growth in revenue, the market should expand into the multiple. Additionally, their net leverage is high compared to the competitors, but this is going to come down in the future. As management has said, they're looking to get below a 3.0x net leverage by the midpoint of this year. That number should continue to go down as the free cash flow yield continues to go up and the free cash flow continues to grow. The obvious risk that comes with ATM services is a cashless society. So with COVID-19 and cryptocurrencies, there has been an increased option of cashless society, or cashless option for consumers. However, it's very unlikely that we're going to see a cashless society for a couple of reasons. Number one, security-wise, we just don't have the infrastructure to do this because if power outages happen in cyber attacks, the infrastructure is not there to set up this kind of cashless society yet. Number two is also the consumers itself. There are a lot of rural Americans who don't live in areas where you can use this sort of online cashless society, and a lot of consumers also just prefer to use cash. So in the off chance that it does happen though, we should see a large decrease in the amount of ATM usage, but it should be pretty good for Atleos because more banks are going to outsource their ATMs to Atleos because it's not really worthwhile for them to do it themselves. It's also important to note that NCR Atleos does have a lot of bulk cash and foreign exchange headwinds, and so they try to offset this with hedging. So this is just something to monitor in the future of their hedging. So overall, with the adoption of AppMass, we should see expansion in the fundamentals of this company. The market currently has a lower multiple on it because of its short track record and its net leverage, but as this number is going to come down and they continue to grow and the track record continues to grow, we should see an expansion of the multiple. And so again, I'm sitting a buy at P5 with a 106% upside. Thank you.
Just for each one of your segments, do you know about the margins for each one of those segments, and as they change their percentage of whatever is a majority, how the margins are going to change?
Yeah, so for the network, the margin is about a 29% EBITDA margin. For self-service banking, it's around a mid-20s percentage. That number should continue to go up in the future though. For TNT, I'm not sure what it is. TNT, the business itself, is a partnership with Cisco Macari, so I'm assuming the margins are pretty high on that as well, but that one is not super significant to the mix between network and self-service banking.
And then for within self-service banking, each one of those segments, do you know about the margins, which one's the highest margin of?
Yeah, so I don't have the specific numbers for the margin specifically. I do know that AppMass has the most highest margin for EBITDA, so that is accretive to their mix. But I don't have the specific numbers on what that is. I know the AppMass is around the higher 20s for the EBITDA margin.
All right, two questions for you. So why are they spun off?
Yeah, so originally the original company was NCR Corporation. They were both a retail business as well as an ATM business. So what they did was they had payment solutions for restaurants, convenience stores, things of that sort, hospitality businesses, and they also had this ATM business. So their pitch to investors didn't make sense in the sense that they had this low growth industry, this cash generation industry of the ATM business, but they also had this high growth SaaS focused section of their business, which accounted for about half of their revenue. They didn't split for any reasons of their cash flows or their balance sheet. It wasn't any of that sort. It was just the valuation of their own company itself. And they thought it made more sense for investors to split off. So you have two separate companies, and it's easier to identify, okay, this is the cash generation, this is the software as a high growth software service, and nothing fundamentally changed for their customers or their employees as well. It was all the same for them.
Okay. And then can you just describe for me again that hardware cycle that you mentioned it, and maybe give us an idea, you know, does the market price that as just recurring revenue, or how are they pricing these cycles in here?
Yeah, so the way they price it in is they try to have a higher increase in the hardware. So most of these street projections, they don't do the revenue build that I did of targeting specifically your ATMAS. It's just revenue in general. It's just self-service banking in general, and they hard code the number into it. But the actual growth numbers for these specific years are higher for hardware, which makes the revenue growth in the self-service banking higher than in other years. This cycle, it's anywhere from 5 to 7 years, so we should see anywhere in 2030 that the cycle should start moving again, just depending on, you know, the age of the ATM, how well it aged, and things like that.
Can I see your balance sheet?
Yeah.
If you can find it. And so why do they spin off this company with so much debt? I'm just curious. Is that a way for the parent just to unload a bunch of debt?
No, it's not. So the net leverage for the parent company is actually relatively the same. The target net leverage when they spun it off was around a 3.0 to 3.4 net leverage, and for NCR Atlas it was around 3.4 to 3.8. Their reasoning for spinning off, for, like I said before, was just mainly for evaluation purpose. It wasn't.
Good. Yeah. And how are they going to pay down? Are they going to pay down the debt with excess cash flow? Can I see your fund flow statement?
Yeah, so they have a large, so this is a really, this business generates a lot of cash just because it's pretty well established. So there's going to be, they've been using their free cash flow to pay down their debt.
Is this their stated intention?
Yeah, so management specifically said on the last earnings call that they're,
Great.
yeah.
All right, thank you.
Yeah.
So when you said 20 to 30% of your customers requires actual like capital investment, so like actual ATM machines, and you said you are there to help them with the financing. What do you mean by help?
Oh, so what they're doing, so in these deals right now, they're the ones who are providing the ATM, the hardware itself. NCR Atleos as a whole is trying to step away from the hardware section of their business. Their main focus is their service because the margins are better there. It's a way to differentiate themselves in the business. So they're actually having a third party financing it, meaning that a third party is going to be the one who's providing the ATM itself and not NCR Atleos.
Cool.
Great, thank you.
All right, last but certainly not least, we'll be hearing from Judy. She'll be pitching car gurus.
Good afternoon, everybody. I'm Vicky Shetty, and today I'm pitching the company Car Gurus. So starting off, what is Car Gurus? So Car Gurus is basically a Boston-based automotive research and shopping website that allows users to compare local listing prices for new and used cars and contact sellers. So this website uses algorithms to analyze and compare listing prices by features and dealership reputation. The company was founded in 2006 and went public in 2017. So my investment thesis is that Car Gurus is positioned for sustained growth driven by an expanding international footprint, a growing and increasing engaging dealer network, and favorable regulatory trends in the used car market. These tailwinds, along with its product innovation and operational efficiency, position Car Gurus to continue captivating market share and delivering shareholder value. So the street is currently underappreciating the company by overlooking the steady marketplace growth in the core revenue and looking at the digital wholesale segment. So my price target is $36, which has a 25% upside. But before we go into Car Gurus, let's look at the market as a whole. So this is part of the automotive retail and technology industry, and it's on the rise. The used car market currently has 6% CAGR, whereas the US online automotive market has a 3% CAGR. This continuous innovation in this market, and along with data storage and analytics, is definitely channeling it. Some key trend drivers to note is that consumers want to have the best decision before buying a car, and they're all relying on apps like this to do that. So these websites are using that to get the best algorithms necessary to integrate AI and data adoption to make their platforms the best possible. In terms of barriers to entry, this is definitely a high one because competition is very intense, and additionally, it's very hard to create a company like this. So my main takeaway from this whole slide, though, is that the industry remains highly cyclical and very sensitive to macroeconomic factors such as tariffs and declining discretionary income, which can dampen consumer demand. So why is CarGurus able to position itself in this competitive market? Well, it's like no other company. There's 4 main points for this. First of all, CarGurus uses data-driven platform with proprietary algorithms, and it's being using that, they're ranked number 1 in the return on investment among listing sites. So CarGurus uses 52 million used car data points, along with further analysis, to come up with something called the instant market value score. So this, along with something called the user dealer ratings, basically generates these different deal ratings between great deal to overpriced. And what this means is that when you go to the website, these different ratings will be right next to the image of the car. So when consumers are looking at this, they'll be able to see what they want to buy, and they usually stick to the greens. So this company is also extremely scalable. It has a subscription model that has different levels of it, which I'll dive into deeper, and it also has a dual-sided monetization. So the company is able to make money both from the users and the dealers. So these are the 3 different revenue streams for CarGurus. The first one's the marketplace growth, and 93% of the gross margins are from this. As I mentioned before, the dealers can either subscribe to one of 3 different models: the Enhanced, Featured Plus, and Featured Priority. Like any model, the higher subscription you get, the more features you get. And CarGurus has made it in a way where if you go on a higher subscription level, you're able to get the great deal rating easier because you're able to adopt the features and techniques necessary to get that. The digital wholesale, on the other hand, is any interaction between dealer to dealer. So Car Offer is CarGurus' new acquisition, and it basically is a platform where used car dealerships between different dealers can switch inventory and do a lot of different aspects of that. The product revenue, on the other hand, is a bunch of different things, including advertising revenue and any excess monetization made between consumers and dealers. So let's dive into my first thesis point, which is international expansion is going to fuel the next chapter of growth. So CarGurus is currently actively investing and expanding beyond the US and to target these unpenetrated international markets, where the online automotive markets are less mature. Not only this, but geographical diversification buffers against any cyclical risk in the US auto market. And as digital car sale trends gain global traction, CarGurus is positioned to leverage their platform and proven playbook to move it and replicate domestic success abroad. And overall, I charted what I think the international market revenue growth is going to be, and it's very high, with 18%. So how is CarGurus able to do this? Well, they're leveraging partnerships. A key example of this is when they acquired PistonHeads, which is a well-known automotive shopping site in the UK with an enthusiastic customer base. So basically, paying dealers in the UK can use the site along with PistonHeads to list their inventory. Having this brand image, where CarGurus is able to scale faster with new entrants and localized presence while having a global platform capabilities. My next thesis point is about the monetization and gains fueled by a rapidly expanding dealer base. So CarGurus has a model where they basically channel revenue through something called the quarterly average revenue per subscribing dealer. This basically means how much is a dealer paying to CarGurus. The average of that has been between $7,000 to higher bids. And right now there's 32,000 dealers present in the US with a growing year-over-year increase in this. So what's making dealers pay more for these things? These are because of features like next best deal rating, which improve inventory visibility, and digital deals that streamlines car sales. And all of this is helping the dealers increase their return on investment and satisfaction, which is their main priority. So as I mentioned before, CarOffer was a platform that helped connect different used cars and inventory retail. So this is a map of where CarOffer is within the US and all the different places dealers can get inventory from. So basically what all this means is that this is creating platform stickiness. It's creating this virtuous cycle of better listings that lead to higher user engagement, more leads, better dealer retention, and finally higher monetization. And this also leads to a cross-selling opportunity. Larger dealer bases create more upsell potential, both for digital retail tools, financing, and advertising. So my final takeaway is about the whole market. So macro trends are accelerating users and dealer dependency on car groups. So basically what this is that we all know with the rising tariffs of new vehicles and tighter car inventory, it's pushing consumers towards used options. And along with this, there are shifts with interest rate and higher inflation, consumers are more price conscious, and used cars offer a better value proposition. Not only this, but even the government is promoting these circular economies and extending life vehicles for vehicles. So finally, even a growing dealer reliance on car groups has made this better. The US car market as a whole is $40 million units of cars per year. And the online penetration remains very low, so car groups have a long growth term. In terms of a dealer value proposition, these product prices are constantly rising, and car groups' tools for inventory management, vehicle visibility, and lead generation are becoming very critical to these dealers. And car groups as a whole is just relying for everybody, for both consumers and the dealers. These consumers are relying more on online platforms to secure the best deal, and car gurus are being trusted to do that. So based on all those trends, I've made this revenue build. So I've broken it down into 3 different segments as the 3 different revenue streams. Looking at the marketplace, you can see that I've projected the US paying dealers to grow gradually, and that's something that's been aligned with the market trends today. But if you look at the international market, I've predicted 13% growth in 2025. You might be wondering why this is so high, and that's because car groups is still expanding into new territories, and when they get fixed in that market, it will slowly start declining the growth rate and become steady. Looking at the digital wholesale, on the other hand, the growth will initially dip because this is what's been happening since car groups has been integrating many different platforms into their mix. So as long as CarOffer is being successfully acquired, it will start seeing a growth in this segment. And finally, in terms of product revenue, I just graphed this mainly off of the used car market growth because it includes many different factors. So why do I think that car groups is different from the street? So if you look at my projections, I projected revenue to grow more both in 2025 and 2026. And I think this is because the street is failing on understanding the attractiveness of the overall market. Car Group's ability to gain market share and grow a dealer base with the international expansion offering and product offering is definitely something to look forward to.
Is your numbers back? Did you make a mistake? Am I reading it incorrectly? Are you below the street?
Yeah, for EBITDA.
Okay.
Yes. So the reason for that is because I don't think the street is taking into comparison what they have to do for international growth.
Understood.
To enter those new markets and to get all the product listings that they want to offer, they have to put a lot of resources into this. So therefore, I believe that even though right now my EBITDA may be lower than the street, I think overall in the future it will definitely switch and mine will be higher than theirs because they've not taken into consideration all of these aspects. So to look at some potential downsides and upsides, in terms of the bear case, I'm looking at a market where the revenue of the US marketplace dealers is on the decline. And if dealers aren't able to use their profitability to go to markets and to help with the ARPU, there might be an issue. But I don't think Car Gurus is going to be affected by this because Car Gurus has positioned itself to be a solution even in these trying times and to help dealers get the best out of their return on investments. So in terms of the bull case, on the other hand, I think that if the international market grows and continues to grow without a decline rate, this is something that could be incredible for car groups, especially if they enter markets like Asia that don't have any other features like this. And in terms of domestic revival, entering a new market and rapid growth is something that paying dealers could definitely look forward to. So as my final takeaway, CarGurus is entering this multi-year growth cycle, and the street is underestimating this. International expansion, gaining traction faster than expected, cultural shifts in the used car market are deepening demand, and digital engagement and new product innovations are driving durable monetization opportunities with both dealers and consumers. As we mentioned before, while the near-term EBITDA margins may be pressured by strategic investments, these moves are building stronger and more defensible platforms for the long-term earnings growth. And as a result, CarGurus is well positioned to capture market share, accelerate revenue growth, and deliver significant shareholder value. I kind of did a quick summary of my growth algorithm of all the things that went into collecting my target price, which is revenue, EBITDA, dealers, and free cash flow. And with that, I'm recommending a buy on CarGurus with a price of $36 and a 25% upside. Thank you.
How did you go from 12 times to 16 times in your bull case? What's your thought process beyond that?
Yeah, so basically, even though the international market is pretty small compared to the US market, I think if they enter markets like Asia and other places, I think that would definitely have a rapid growth. And in terms of the bear case, even though I mentioned I don't think that would possibly happen, I think the base case is definitely what the market's going to project. I think that I took into, I think the worst case scenario is if the market stays the same. And I don't think that's going to happen. So if the market stays the same, I think that's something we can look forward to, which is like a baseline of growth, but nothing crazy.
Yeah, on that note, why is the street so? Because I guess the bulk of your differentiated view really is this international expansion story. So why is the street so bullish on international expansion? Is it something to do with their penetration, or is it just the TAM isn't as big as you think it is, or?
I think entering the international market's tough. I think that CarGurus has kind of mentioned it on different earnings calls, but I think that this is something they definitely have to put into motion, because right now they have places in Canada and the UK, but they haven't mentioned like rapid expansion in Asia. So this is more like what, based on earning calls, like the most recent one, what they predict is going to happen, which is like increasing the international market.
What's the competitive landscape? How's that compare to the domestic market?
I think overall, like in different places, like I mentioned, CarGurus is very like strategic with when they enter a new market, they want to like get the best like audience. And I think like for example in UK, the Piston Heads, they go into markets, they acquire like similar companies, and they like use their dealer base to like help leverage their company. And they use a lot of resources to do that. That's why their EBITDA might be low, but in the long term, it's definitely something to look. Yeah.
Could you talk a little bit about what has been going wrong in the wholesale segment and why you think that doesn't really matter?
Yeah. So as I mentioned, if you look at the three different revenue streams, the marketplace is actually generating 93% of the gross margins. So both the digital wholesale and the product revenue aren't really adding much to the company. So before in the digital wholesale market, CarOffer had some integration issues since they kept acquiring bits and bits of it, but they didn't fully acquire the whole thing, so they weren't able to integrate that software into their website, and they had some issues with that. So now that it's fully acquired, I think that this is definitely gonna start growing rather than declining. Yeah.
How profitable is the car bidding market for CarGurus?
The car bidding market? I'm not sure if CarGurus does bids. I think it's like one-to-one deals, or like they connect with the dealership and you go there. So I'm not sure if it's a bidding market. Yeah.
Thank you.
Thank you.
All right, folks, that concludes the pitches themselves. Stick around, though. We're going to have a 5-minute kind of deliberation period over here in the corner. Stay where you're at, though. You'll see why in a second. But thank you for your attention. Let's give one more round of applause, not only for our pitchers, but also for our faculty advisor, Professor Saletti.